How is the millage rate determined? Have you ever wondered how local governments decide how much property tax you owe? The millage rate plays a key role in this process. Let's break it down in a simple way. The millage rate, also known as the mill rate, is the property tax rate used to calculate taxes based on the assessed value of real estate. It tells you how much tax you will pay for every $1,000 of your property's assessed value. 1 mil equals $1 in tax for every $1,000 of assessed value, which is the same as 0.1% of that value. So, how do local governments come up with this rate? First, they look at their budget needs. Local governments need money to fund essential services like schools, police, fire departments, and infrastructure. They calculate how much revenue they need from property taxes and divide that by the total assessed value of all taxable properties in the area. This gives them the millage rate. Next, properties must be assessed to find their taxable value. This assessed value is usually a percentage of the market value and is often lower than what you might expect. The assessed value is what the millage rate is applied to when calculating your taxes. Another important factor is that multiple taxing entities can set their own rates. For example, a county, city, school district, and special districts like fire or water districts may all have their own millage rates. These rates are added together to create the total millage rate for your property. Additionally, there are legal limits on how high the millage rate can go. Many areas have caps set by state law or local ordinances. Sometimes, any changes to the millage rate requiring approval from voters or local governing bodies. This ensures that tax increases are transparent and fair. Once the total millage rate is established, property taxes are calculated by multiplying the assessed property value by the millage rate and then dividing by 1,000. For instance, if your property's assessed value is $200,000 and the millage rate is 15, your annual property tax would be calculated as follows. 200,000 divided by 1,000, multiplied by 15, which equals $3,000. For anyone investing in real estate, understanding how the millage rate is determined is essential. It directly affects your annual property tax expenses, which in turn influences your cash flow and overall returns on investment. It's wise to research local millage rates and how they are set. Keeping an eye on changes in local government budgets or tax policies can help you anticipate any shifts in the millage rate. Knowing how the assessed value process works can also prepare you for potential tax reassessments after you purchase or improve a property.